Good afternoon, everyone. My name is Angel Velez. I am with Home for Life Realty, and I am here with Cecilia Ramos. And Cecilia, welcome to our podcast today.
Thank you so much thank you, Angel, for inviting me. Again, I'm Cecilia Ramos, aka CC, the loan officer that's always working for you with New American Funding 96205.
Cecilia, I brought you here because I've been thinking about these clients, and the interest rates have been going up. Last year was a little bit of a slow year. And I know that in 2024, there's been predictability about rates changing, maybe being dropped this year. So what's your perspective on the rates? What's going on in the market with rates?
That is the $1 million question.
Yeah.
Definitely. Yes, we are definitely doing much better than we were in 2023. I saw rates as high as 8 to 8.25, especially for a first-time home buyer. And one thing that, again, I'm so happy that we're doing these videos because educating buyers and how rates are determined is very important. Obviously, it's based on the market, the economy, etc. But for us as lenders, bankers, mortgage companies, we're going to provide interest rates based on the risk, right? So if you have the person that's, putting 20% down with awesome credit, they're going to get a much lower rate than someone that's not putting any money down, right? But what we are seeing the trend that they are going down. And I'm very thankful for that because, when you're looking at, in some cases, a low to moderate income person that may have a little bit of debt, a 7% rate could take away from their buying power.
I was going to say that's the biggest impact on buying power. Individuals that can buy a $300,000 home just a couple of years ago, maybe 3 years ago max, now locked into maybe buying a $250,000 home. That's how much the buying power with the interest rate impacts the sale. So I'm glad you brought up that point.
Yes, and we're really thanking the government that they're stepping in and they're seeing the necessity to stimulate the market to get sellers that are either outgrowing their homes or ready to retire, to sell and to go move so the next buyer can step in. So we are seeing a trend already. Like this past week, I priced a couple of loans between 6.5. For a first-time home buyer, someone that's putting down payment about 6.25. And I'm not fully quoting rates because I don't have an annual percentage rate to give you, but definitely we are hoping for the second quarter going into the third quarter that we're going to see a nice dip in the rates. Everybody talks about election. I'm not an election guru or nothing like that. But the predictability that we are trending downward, and I think it's going to really open the market up for a lot of buyers. Construction rates are really awesome too. So, this is the time, you never know what the market's. I always tell clients, get it while you can. Yeah,
they shouldn't be driven. And it's hard to tell a client that don't be driven by the rate. What is impacted is their buying power. But once you get the property, you can always refinance.
That's the key.
And by the way, rates at 8.5, that's a little bit steep. But rates at 6.5 and 5.5, those are kind of standard rates. We just got spoiled back in during 2020 and 2019. Yes. Even during the COVID year, where the rates were down to 2.5 to 3%.
Yes.
And so the folks that have been standing on the sidelines and missed that opportunity are regretting it. Yes. So I think if rates go down to 6.5, I've always been a believer that you should not be driven as a buyer by the rate.
That's true.
Be driven by affordability.
There you go. That is the key word. I come from an era, I've been in the business 25 years. And I remember doing first mortgage rates at 9%. So when I tell people we've gotten very spoiled, it's okay. We've got a little bit we can, but the market has changed. But here's the good news. You said the key word. Eventually they will drop again, and they might drop again. So you're buying at the highest, the peak. So in a few years, if the rate drops again, we're going to save you some money. Now you have some residual income coming in because now we're going to cut that rate and your payments are going to go down.
Absolutely.
So like Angel said, he's one of my, best agents out here that he's always in tune and, trying to understand. We always pick at each other's brain about what's going on. And guys, don't be driven by the rate. Do what you can do now because we don't know what the future can tell because the government could flip on us. And we're back to 8%, and you were waiting on, and not even that. The prices of the houses keep going up.
And that's the thing. A lot of people sit in the sidelines when the rates were low. They say the prices of the homes would go down, and it's actually had an opposite effect. The rates were going down, yes, but the houses were going up. And now what's going on, even though we've leveraged, level off a little bit, where the properties are going up, now, at least in the state of Virginia, they're going up at a standard of between 3 to 4%.
Yes.
But this doesn't mean they're getting any cheaper.
No.
Typically, houses appreciate; they don't depreciate unless we have a crash of the market. But right now, it's looking steady. It's looking pretty decent. Last question, Cecilia. Last question. The rates. Is there a difference between a government loan and a conventional loan rates? And what's the difference between the two?
That's a really good question. There is a difference. It's based on the risk. You know, most government loans, with the exception of VA, but when you look at a USDA mortgage or an FHA loan, because those have lower down payments.
Those are government loans.
Those are government loans. So when you're putting a less of a down payment, it's a more risk to FHA or USDA. So the rates, it's higher. On a conventional loan, if you're putting, for example, 20% and you have 800 plus, you are going to get a much better rate because you've demonstrated that the risk of what we're financing is lower. And you have really great credit versus someone that their credit is not as strong. And not having strong credit doesn't mean you have bad credit. It could just be like you just don't use a lot of credit, right? So your scores might be a little bit lower. So yes, on a government loan, it might be a little bit higher because of the risk that we're taking in the sense of giving you more of what we're financing. Versus a conventional loan, you got really awesome scores and a larger down payment, you're going to get a better rate. But on a conventional, even if you had 20% down and your scores are really low, then you're going to get a higher interest rate. So it all depends on, it's what I call in my industry the risk factors. What risk are we going to take with you, and that's going to determine what your rate is.
So it'll vary person to person. That's really the bottom line.
That is true.
Well, I appreciate your time, Cecilia, and set the stage here for hopefully a prosperous 2024 for those that are out there looking to buy, and don't be driven by the rate.
That's right.
Thank you.
Thank you for having me again. Have a great day, guys. See you soon.